You need to hear this. If you're an investor, welcome back to the channel, Smashing Goals. Remember to like, subscribe, and share the video. This is not financial advice. Always do your own research. We are going to talk about the latest US jobs report. The US economy added 142,000 jobs in August, below the expected 165,000. The unemployment rate dropped to 4.2%, pointing to a cooling labor market. This mixed bag has the Federal Reserve considering interest rate cuts, and this is what we waited for all along, cutting those rates. So wage growth hit 3.8% year over year, raising inflation concerns, and now some economists think we're looking at a soft landing, avoiding a recession. The Fed's debating how much to cut interest rates. Will it be 0.25% in September or a bigger cut later? The Fed plans to cut rates on September 19th, so keep this on your radar. When interest rates begin to be cut, several key trends and expectations emerge in the financial markets and the broader economy. One, we get a boost in stock markets, having a lower interest rates, reduce borrowing costs for businesses, encouraging investment. This typically boosts stock prices, particularly in growth sectors like technology and consumer discretionary, as future earnings are discounted less. Two, bond prices increase. As interest rates fall, existing bonds with higher interest rates become more valuable, leading to a rise in bond prices. Investors may shift towards fixed income securities for safer returns. Three, consumer spending rises. Cheaper borrowing costs often translate into increased consumer spending, especially on big ticket items like homes and cars. Lower mortgage rates can also spur housing markets. Four, inflation risks. While interest rate cuts are often designed to stimulate economic growth, they can also lead to inflation if demand increases faster than supply, pushing up prices. Five, weakening of the currency. Lower interest rates can lead to the depreciation of a country's currency as investors seek higher yields elsewhere, impacting international trade and making imports more expensive. Six, stimulated economic growth. Interest rate cuts are typically implemented to prevent or address economic slowdowns, making it easier for businesses to invest and expand. So now, what are the market impacts? In terms of specific market impacts, sectors like utilities and real estate, which are interest rate sensitive, often perform well in low rate environments. Additionally, dividend-paying stocks may become more attractive as bonds yield less, pushing investors towards equities for income. Back to the jobs. Since businesses aren't planning major layoffs, but slower hiring could hurt future growth. Despite the slowdown, the job market shows resilience. Stay tuned, investors. This could be our ticket to a stable economy.